Brandon, have you met Larry?
How's it going?
Larry, this is Brandon.
Hello, Brandon.
I don't know
Nice
where
to meet you.
Gassman is, but he's around here somewhere. Brandon is definitely the brains behind the operation, that's for sure. Brandon, have you ever heard of Tiger Tables?
I have. I use it often.
Good.
When did you first learn about it?
Probably day one of working at your law firm, or Alan's law firm.
Nice to hear. Nice to hear. Larry needs the money, so we're very glad to support him. In fact, he doesn't have a home. He lives in a Chinese restaurant. Actually, a Japanese restaurant. Larry, I heard you have a pet snake.
Yes, indeed.
Well, when you lead this presentation at noon, I hope you'll show us that snake, because I've heard it's a beautiful, beautiful king snake.
It can be arranged, yes.
Okay, very nice. So Larry, our audience is not very smart, so when we talk, we have to go really slow for this audience. Gassman is a terrible presenter. He makes a lot of mistakes. Brandon then has to correct him all the time. It is not true that Brandon is taller than Gassman, though. Actually, Gassman is the same height as Brandon. Okay, I see the cat from Connecticut. He is here. Larry's daughter is a veterinarian, so if you have any questions about dog or cat care or the care of a 20-foot Burmese python, please put that in the question slide. The show will begin in 1 minute. For many of you, that is 2/10 of a billable hour, but it's actually 1 minute here. And please turn your cameras off. We don't want to see you. We only see Brandon and Larry. All right, Gassman's coming. I'm getting out of the way.
I'll be back in a minute.
Okay, super. So those of you who are early, you just saw Larry Katzenstein. Larry is one of the smartest and most giving members of the tax law and estate planning law community. Larry wrote Tiger Tables in 1985 on an old IBM PC, and he's going to sit in on this presentation so that Brandon can be nervous. And he's also going to lead a presentation at noon to talk about Tiger Tables. And if you're not a tax lawyer or CPA, I think you're still going to really enjoy Larry's presentation. So did I start broadcast, Brittany? Perfect. Good to know. All right, before we get started, if you came in through cpaacademy.org, you're going to get free CPE credit. You have to answer, I think, 3 of the 4 polling questions. If you came in through our law firm, you unfortunately are not a CPA, or at least you're not going to get credit. And the program's actually not good enough for credit, but don't tell cpa.org. All right. Larry Katzenstein, I'll introduce later, but as I said, he's a leading tax and estate planning lawyer. We are really pleased to have him on this webinar today. There is no financial relationship between us or CPA.org and Larry. He's here because we invited him, because he is legendary. He doesn't charge enough for this software. It's just been probably an expensive habit. I do want to engage in a little bit of shameful self-promotion here. If you know anyone who had storm damage and they are not happy with what their insurance company is going to give them, they should watch our webinar and learn all these tricks of the trades that are on this webinar. There's just a lot of people who got hurt in the storm financially. And one thing to remember is, if you have storm damage and it is a declared disaster, you can file your 2021 tax return again, showing your unreimbursed storm damages, which can include loss of value of your home. Not only what it costs to fix it, but loss of value. and you can get a refund from your 2021 tax return, even though this storm has occurred in 2022. So see your tax preparer, or if you are a tax preparer, learn about this so that people know they can go ahead. Because, for example, I have my friend Craig Hirsch in Fort Myers, a great estate planning lawyer. He was in 2 feet of water on the first floor of his house. So even if it costs $400,000 to fix his house, that house is not going to be worth what it was before. Not because Craig lives there, but because that house was underwater. So Craig can refile his 2021 tax return, and I hope he does. Everyone knows that we have a lot of programs here. Jerry Hash asked me to remind everyone that Notre Dame will be November 9th through November 11th. It is all cyber. It is wonderful. You can watch programs. They'll record programs for you. And Brandon will be appearing November 9th. He and Christopher Denicolo are going to do a 2-hour talk on the Secure Act and planning for IRAs, etc. So enough of the shameless self-promotion. Brandon, I'm going to turn this over to you here on page 22. Are we sharing screen?
Yeah, I think so.
Perfect.
I can change slides here. Actually, no, let me request control from you.
He's been doing that his whole career. Somewhere. There it is. Give control. That's a hard thing to do. All right.
Okay, so we wanted to just give a little bit of update on employment taxes, basically, because a lot of this that we're going to talk about with Section 199A involves paying wages, and there's a tax cost to that. Employment taxes have to be assessed on those wages. So we have this chart to just kind of break it down for everyone, what the employer pays, what the employee pays, what you pay if you're a self-employed individual. So we have the 2022 rates here. The Social Security base is now $147,000. So you have Social Security tax that applies up to that amount. That's 6.2% by the employer, which is deductible by the employer, 6.2% by the employee. And then if you're self-employed, you get the full 12.4%, and you get to deduct 1/2 of that. And we'll have some other charts that show the exact cost on those amounts. In addition to that, there's a Medicare tax, 2.9% on all income. There's no cap. So like the Social Security tax, it drops off once your wages get in excess of $147,000 for this year. Medicare tax still applies. Again, that's split between the employee and the employer. And if you're self-employed, you pay the full 2.9. Now, there's an additional Medicare tax if you are a high earner. If you make over $200,000 single or $250,000 as a joint filer, there's an additional 0.9% tax on that, and that's no cap as well. It just applies to wages in excess of those threshold amounts. 2023 numbers are here. You can see the inflation rate has really kicked up these bases. You're going to see that again for all the income tax tables, for the estate tax exemption as well. With high inflation this year, these thresholds amounts are going to jump a good bit for next year. So what does this cost us if we pay $100,000 of salary? Well, it's going to cost the employer $4,800 roughly, the employee $7,650 for a combined cost, if you're self-employed, of $12,470. If we're paying over $250,000, then that almost doubles up to $20,000. So that's a little bit of the cost associated with the payment of wages. Alan, anything you want to add there?
No, but it's just important because it's easy to say, well, for 199A, I'm getting this deduction, not realizing that your wage or your employment tax could be worse. So one thing's treated against the other. You've got to run the numbers.
Absolutely. Yeah. And that's, that's easy to say, well, and we'll get to some of these, but just to talk a little bit about it now, if you make over a certain amount of income, you have to pay a certain amount of wages to get the full deduction. So if you're short on wages, it's easy just to say, well, I'll pay some more wages and be able to qualify for that deduction. But it's important to run the numbers out on that because it might cost you more than the deduction's worth. So just be careful when you're planning as far as what you're doing there.
Right, because it used to be that every small business should be in an S corp, but now if you're in that S corp and you got to pay wages, could be better off just a Schedule C business when you run those numbers on the smaller businesses, especially if you're an Uber driver and working so hard, making $80,000 a year. Used to be that would be an S Corp. Now that's going to be a Schedule C.
Another thing we wanted to just introduce before we get into this is the new kiddie tax brackets and how that really impacts Section 199A planning. Is a lot of what we're going to talk about is using trust or low income taxpayers to get another threshold amount, shifting income to a child, shifting income to a trust for the benefit of the child. Well, that all works great, but if the child doesn't support themselves, then this kiddie tax can apply and you're back up in the parent's highest rate bracket. So this is not as easy as just sending money to a kid using their rates and qualifying for the deduction. There's a little bit more involved there. So we'll go through the kiddie tax in more details, but here's the numbers. If you have earned income, you get a little bit of an exemption, about $1,100 roughly. There's a 0% tax rate. If you're below $2,300, you can still use the kids rate bracket, that's around the 10% rate bracket at that level of income. And then if you're above $2,300, you're back to the parent's top marginal rate, which could be all the way up to 37%. With the deduction for 199A, that's around 29.6% as the rate bracket. Alan, any thoughts on the kiddie tax?
Do we have slides later where we explain
We
how
do.
Okay.
Yeah.
Everybody stay tuned. That's not a tax on cats. That's a tax on including older children who are still in school. So drop out after age 24 and you're good. We'll discuss that.
So Section 199A, it really comes from 5 main places. There's abilities for charity to get 199A deduction as well. Number 6, you see there at the bottom, if they have unrelated business taxable income. But generally, we're talking about S corporation income, partnership income, Schedule C income, rental income that's on a Schedule E, or farm income from a Schedule F. That's mostly where this income is going to come from. The other things that you really need to know is there's a lot of acronyms in the Section 199A world. There's QBI, which stands for Qualified Business Income. That's that income from one of those flow-through entities that one of the 5 I mentioned earlier: S corporations, partnerships, disregarded entities, Schedule Cs. That's your qualified business income, and that's what you get the deduction on. It's a 20% deduction on your qualified business income. So if you have $100,000 of income, you're only going to pay tax on $80,000 of that income, is how Section 199A works. Now, specified service trades or businesses, or SSTBs, not to be confused with STDs, even though they are kind of a tainted entity a little bit. You have these certain categories of businesses where if you have taxable income exceeding certain amounts, you just don't get the deduction. So generally that's medical practices, law firms, accounting, insurance. There's about 11 of them. We have a slide with them listed out, but those are categories where you have to be careful with, and a lot of the planning's involved there, because that's where we really want to take advantage of moving that income to get another threshold bracket if we can.
And for those of you who are lawyers, we have a separate company that receives any lecturing income we have, any royalties on our book sales, trustee fees, personal representative fees, title insurance. That's not the practice of law necessarily. So if you're a CPA representing lawyers, first of all, you have my sympathy, but secondly, you can push that out to a separate entity that doesn't have to be an SSTB, and we'll be giving examples of that. Another big category for this is consulting, because there's just so many different businesses where if you're doing consulting as part of the business, well, I'm a roofer, but I do go out and help people determine if their roof is broken and I charge expert fees. Well, then you may be a consultant. So we'll talk more about that, but I just thought I would throw that in case anyone is sleeping later.
Yeah. Basis is another thing that's important here, or unadjusted basis immediately after acquisition, or UBIA, as it's referred to as the acronym. And where that comes into play is if you have basically real estate ownership, or you have a company or a business that doesn't have a lot of wages, but it owns a lot of assets. You can use the basis on those assets to help qualify for the deduction if you are a high earner. W-2 wages are also very important. Again, if you are a high earner, over certain thresholds, you have to pay a certain amount of wages or have a certain amount of basis in order to qualify for the deduction. And then guaranteed payments, that's not a wage. So be careful with partnerships there. You can't just make a payment to a partner of a partnership to count as a wage to get the deduction. That's not going to qualify. We also have a nice safe harbor for non-triple net lease rental activities. If you work over 250 hours on that activity, that's going to be an active trader business, which we know it's hard to qualify as an active trader business for rental properties and rental real estate. But if you meet that safe harbor, then you can qualify. So again, this has to be active income. How do we know what's active? Well, 162 is the code section, but there's not a lot of guidance there. It's mostly court-based. Again, the traditional, the pornography test, right, is you know it when you see it. I can't really tell you what the rules are, but the courts just kind of say, yeah, that looks active enough to me, or, you know, there's a lot of factors involved. So it's hard to say it's not a certain amount of hours, it's not a certain amount of activities, it's not certain activities, it's just, you kind of know it when you see it. So we'll give a little bit more tips on that as well. So Alan, go ahead.
A lot of you, and we too, we have a lot of clients that rent a lot of properties. They're in the, I don't know, oh, you're fine. We have a lot of clients who are landlords. So then when they die, to get a payment plan from the IRS, the question is, was all that an active business? And then do they get this 20% deduction? So going back and renegotiating these leases, charge the tenant a little bit more and do janitorial, do active management, things like that. We have articles that we've written on this. We're glad to share them, but just a lot of people out there, especially if you have more than 35% of your net worth in these rental businesses, and you have estate tax exposure, or you want to save income taxes, that's a big part of it. So this is the most important slide, because this slide shows you that if you have a specified service trader business and your client is a high earner, and it's really not that high, is it? $340,000 for a married couple. Or then you have this issue if either you have a specified service trader business or you don't pay enough wages or have enough property in the company. So Brandon, I think this would be for today. I know a lot of you laminate these charts, then you take them in your hot tub, you discuss them with a glass of wine. This would be the one to laminate today for the hot tub experience.
Yep, so this is our two main rules, right? So category 1, specified service trades or businesses, those tainted industries that have certain limitations on taking the deduction. If your income is under $340,100 as a married couple, that's the 2022 threshold brackets, then no limitation applies. Doesn't matter amount of wages you pay, it doesn't matter what the business is, you get the 20% deduction on the income. If you're over that amount and under $440,000 as a married couple, then there's a phase out range. So if you're halfway through the phase out range at $390,000 of income approximately, your deduction is going to be 50% of what it otherwise would have been. So you get a 10% deduction on your qualified business income. If you're over $440,000, then you get no deduction. And that's where some of the planning that we're going to talk about later might come into play, where you can shift income to a child or other taxpayer that's under these thresholds and then qualify for the deduction that way. Now, you are actually giving the money away, so you're not going to get the benefit of it. But for tax planning, if you're going to make gifts anyway, then business entities are a good way to do it, particularly when there's income tax benefits as well. Now, the wage and qualified property test is the second limitation. even if you're not an SSTB, you have to worry about this wage and qualified property test. Now, if you're under the threshold, doesn't matter the amount of wages you pay, doesn't matter what property you have, no limitation applies, you get the full deduction. If you're over the threshold, so if you're over $440,000, then you have to pay, basically, if the deduction is going to be, let's say, $100,000, you have to have wages of $200,000. So 50% of your wages has to equal your deduction. Otherwise, it's going to be limited to 50% of your wages. So if you have, let's say, $1 million of income, your Section 199A deductions, therefore, there's going to be $200,000, and you only have $100,000 of wages. You're the sole owner of an S corporation, and you pay yourself $100,000 salary. Your deduction's limited to $100,000 because you don't have enough wages there. Or sorry, your deduction's limited to $50,000 because you don't have enough wages to qualify for the full deduction. So you might consider increasing that wage. You might consider hiring someone to get that those wages up. But again, worry about the cost of the wages as well, not just qualifying for the deduction. The other way to qualify is if you have a lot of property in the business, you can add 25% of your wages plus 2.5% of your basis in the property to get up to the level of the deduction and therefore still qualify. Alan, any questions there?
Well, I think it's just worth mentioning that mathematically, it comes out to about 28.6% of your profits need to come out as wages. And then the rest of your profits could come out as K1 profits, and you can qualify for the full deduction if you're not an SSTB. If you're an SSTB, then you have these issues. That's a way to look at it.
So one of the things too to consider here is aggregation of entities to determine whether you're a business or not. You know, if I have 4 separate LLCs, each of them are taxed as partnerships, I have to look at each of those independently to see if those are businesses and qualifying for the deduction. But if I combined all the activities under one partnership and then, you know, had layers at the top, then, you know, that's going to allow for the aggregation of those activities, and you might qualify as a trade or business that way. But you also have to worry about, you know, liability issues. You might have had these separated out for liability protection reasons. So a better way to do it might be this way. You have a partnership at the top layer with subsidiaries underneath that are all disregarded for income tax purposes. Now all of these activities can be combined at Holdco LLC level to determine whether or not you have an active trade or business. So that's something where, like, if you have a bunch of real estate and you're renting real estate, you know, just one property being rented, probably not an active trade or business. If you combine 4 properties and you have a management company that services the properties, that goes out and takes care of the landscaping, takes care of the common areas, repairs the apartment buildings that might be under these. Now that's looking more like a business that could qualify. So consider entity structuring, how things are laid out in order to best qualify as an active trade or business. So I think that gets us to our first polling question of the day here.
Okay, the section 19, by the way, the answer is always all of the above. And as soon as we have 90% people answered all of the above, we can go to the next slide. But in this polling question, the section 199A deduction, A, applies to income from certain active trades and businesses. B, applies to income from flow-through entities. C, is subject to certain limitations depending on the type of business and the income of the owner. And D, the correct answer, all of the above. Drum roll. Okay, most people answered D, all of the above. Brandon, back to you.
Okay, so when I was talking about aggregation there, I just wanted to point out that that's a different type of analysis as to whether you can aggregate for wage and qualified property testing. So, you know, there's aggregation rules that allow you to combine wages or property from multiple entities that are commonly owned to see if you qualify for having enough wages or having enough property. There's different rules that apply there for that type of aggregation versus this aggregation of looking as to whether or not you are a trade or business. So just wanted to mention that. Here are your list of the tainted specified service trades or businesses. Again, health, law, accounting, actuaries, performing arts, consulting, as Alan mentioned. This is, a tough one that could catch a lot of things. Athletics, financial services, brokerage services, trading or dealing, investing in partnership interest or commodities, or this principal asset is the reputation or skill of one or more of its owners or employees. We were worried about 11 a lot, but luckily the final regulations made that one not quite as punitive as it could have been. And really that's more talking about like someone like Jimmy Buffett, I guess, is a good example in Margaritaville. His reputation is really what's driving that. He gets a lot of royalties and licensing fees from that reputation. That's what they're targeting there, not necessarily a highly skilled individual that might, be outside of one of those injuries, or outside one of those industries, and therefore they're not caught with that catch-all category of number 11. So I think another important thing to point out is this SSTB, even though the entity might earn $1 million, for example, that doesn't taint it completely. It all depends on the threshold and the income of the owners of that entity as to whether or not you can qualify for the deduction. So on the left, you have child one, he's single, he has less than $160,000 of income. No problem, it's an SSTB, but it doesn't matter. They're below the threshold. So we can take the 199A deduction. Child two's married, they have less than $321,000 of income, we're good to go. Doesn't matter, that is an SSTB. We can take the deduction. But the client, who is the high earner, makes over $40,000 in 2022. That's where we run into this problem. They cannot take the 199A deduction, but nothing prevents child one or child two from taking that deduction. So how do we get income over to child one and child two? Well, we got to be careful there because of this kiddie tax. Again, it applies if you're under 18, and also if you're under 24 and you're a full-time student without significant income. And basically the rule of thumb is that you have to have earned income that exceeds 1/2 of your support. So if we look at it this way, if someone's earning $13,000 working in the mailroom here at Alan's office, they have to earn that amount, and so then Alan could then provide $25,000 of support to that child, and that child would not be subject to the kiddie tax. If Alan provided $30,000 of support to that child, then he might want to increase the salary a little bit so they're not subject to the kiddie tax, but then they would be subject, to the kiddie tax if they're only earning $10,000 and receiving $25,000 of support. And therefore, since they meet that test, they fall under the kiddie tax rules. They pay tax at Alan's rate instead of their own rate. So again, we can plan for this a couple of different ways. One, getting them earned income. Two, limiting the support provided or limiting where that support comes from. Maybe we can do some planning there. So what exactly is support? Well, we're talking about all the essential items of life: food, shelter, clothing, medical, dental care, cost of insurance, dry cleaning, babysitters, bicycle repairs. These are all examples from the B&A portfolio. I think it's pretty all-encompassing as to what is support. But one of the interesting items is educational expenses. How do those work? Well, Section 529 plans are pretty popular. And the question becomes, is a 529 plan considered support from the parent or support that the child is providing themselves? This can get real important, when you're in college, because that might be a good time to start gifting business interests to this child, getting them that income, qualifying for thresholds. But if we can take the position that that 529 plan that pays for their education, pays for their room and board, doesn't qualify as support, then we're in a good spot, particularly if they're working at that point in time as well. So there's two conflicting views. We kind of fall in the position that it's not support. And the reason for that is if there's non-qualified distributions, then the beneficiary pays the tax on that. And because of that, we think it's kind of their own support. The other one is if you can, others say that because the parent, maybe the owner of the account, can change the beneficiary of the account, then it's really support from the parents. So there's kind of an interesting take there. One of the ways you could do that is maybe just change the ownership of the account, possibly, not have that type of control, and then that 529 plan looks even better. Any thoughts there, Alan?
Well, definitely if they're over 18, just let them drop out so they're not in college.
Yeah, there you go.
Then you can use that lower bracket. But no, I mean, the key is for all that explanation for people who maybe didn't understand it. If the 529 plan, you just gift it to your grandchild, you give it to them, and then they support themselves from it. And then you're not providing more than half of their support.
Yeah.
And by the way, I think, Brandon, the kiddie tax now, because it changed in 2017, the kiddie tax now is just the highest bracket once you reach that $13,000 or so threshold. It's not.
No, because the tax, to give you a little history there, the Tax Cuts and Jobs Act did make it the trust tax rate brackets, which would mean you're at the highest bracket over around $13,000 of income. But then the Secure Act eliminated that and kicked it back to the old rules where it's based upon the parents' brackets. So, but most of the time it is going to be the highest bracket, because if you're doing this type of planning, we're talking about high income earners. So generally you're looking at, the highest bracket. So one of the things that is interesting here is, yeah, I love my child. I'd love to give them income from one of these SSTBs so I can get them in a low, take advantage of their lower bracket, take advantage of their 199A threshold. But I don't trust them with the money. I don't want them to get $100,000, every year and be able to do with it what they want. How can I structure it so it's not them directly? Well, that's where trusts come into play. So we can use trusts for this type of planning. We can keep it exempt from estate tax, keep it exempt from creditors. But there's, several different types of trusts that could work. Some work better than others, and some just don't help you at all in this arena. So let's just go through kind of the basics of all the different types of trusts that we could use, and which ones might be most useful for our purposes of Section 109A discussions today. So we have grantor trusts. That means the grantor's treated as the owner for federal income tax purposes. These types of trusts, yes, they're probably the most popular trust that we do, and probably one of the more common types of trust, but they don't help us at all for Section 199A planning, because the grantor still pays the income with that trust, is considered the owner of the assets of that trust for income tax purposes. So it's like a tax nothing for income tax purposes. So it doesn't help us there, which means we got to be really careful with drafting these types of trusts and making sure that there are no grantor trust powers, because there's certain types of things that are included in trust that cause this tax treatment that you have to be very careful in drafting to avoid. So for the CPAs out there that aren't entirely sure what I'm talking about, I think this is where having a legal advisor come into play makes a big difference. You can't just do this on your own. You can't just take a form trust from the internet, contribute assets to it, particularly for 199A planning. It's probably not going to work anyway because of some of the rules that otherwise apply, but making sure you're doing this the right way. Complex trust, that means the trust pays its own taxes. That's the type of trust that we need for 199A planning. We need that to have a separate threshold, and it's a separate entity for tax purposes. It holds income and then distributes it out to beneficiaries, and basically the income follows the distributions. So if there's $100,000 of income in the trust, 4 beneficiaries, you distribute out $25,000 to each. Those 4 beneficiaries would then pay the tax. To the extent that the income is retained in the trust would then pay its own taxes. Now the rate brackets are very compressed, so that the rate brackets get very high very quick, up to 12,750 of income, I believe, in 2022, gets you in that 37% bracket. So you got to be careful about planning when to make distributions, when to not make distributions. Those are all important considerations for complex trust. So one nice benefit is you have 65 days into the next year to make distributions to carry out that income, and it's considered as having been made in the previous year. So for 199A purposes, we can look at the beneficiary's taxable income at the end of the year, see where they're at. Maybe they have $100,000 of taxable AGI. So we know we can distribute up to, I forget the number for the single individual now, let's call it another $50,000 at least to that beneficiary from this trust, and they're still not going to be bumped above the threshold. Therefore, we can carry out that income to them as well. Charitable distributions can be made from these trusts. There is the Medicare tax to have to worry about, so that's a complex trust. Now, when you have S corporation stock, it can be held by one of two types of complex trust, either an ESBIT, ESBT, or electing small business trust, or a QUIST, a qualified subchapter S trust. Differences between the two is that the ESBIT isn't necessarily required to distribute its income, but to the extent that it has S corporation income, it's taxed at the highest rate bracket. So a little bit of a disadvantage there, but there's no required distributions. The QUIST basically pays out all of its income each year, and then is at the rate bracket of the beneficiaries to the extent that it's paid. The other type of interesting trust here, and we're going to talk about this in more detail in a little bit, is the 678 trust. Essentially, that's just a type of trust where the beneficiary of the trust pays its own income. So we'll talk about how you set those up and talk about why that might be useful.
Brandon, can I chime in a little bit here?
Yeah.
So the first thing, one of the things Brandon said, I just have to echo this, and I'm sure Larry has seen it as well. A lot of tax return preparers assume that a trust is complex, and it's not. You know, if somebody has the ability to add a beneficiary, then it's just not a complex trust. So when you draft a trust, if you want it to be a complex trust, you have to be really, really careful. And if you're an accounting firm, and just because the last accounting firm treated it as complex or disregarded doesn't mean that it's complex or disregarded. So just a lot of mistakes there. The other thing is you can have S corporation stock owned by a grantor trust. You can have it owned by a complex trust, which makes that ESBT election, which really doesn't make a big difference in a complex trust. You could have that 678 trust, which in my video before we started is taxed to my granddaughter, even though it's really for the benefit of my wife, my daughter, and my granddaughter. It's all taxed to my granddaughter, and it could own the S corporation stock, and it could make what we call a protective ESBIT election, and then the QSST. So these are technicalities that have to be attended to carefully, and they often are not attended to carefully. So you could do a lot of these things. The other thing is you can't just make a distribution from a complex trust to charity and get an income tax deduction unless the original trust document specifically allows for that. You can't change that later. So just, don't try this at home. Be careful with it. And if it's done properly, everything can go well. The other thing I just want to mention, just in case we don't get that far, is that you could set up a management company. Because I know a lot of you are hearing this and saying, well, I'm a doctor. I can't put a doctor's company in my grandchildren's name. It has to be owned by a doctor. I'm a lawyer. It has to be owned by a lawyer. Well, you could set up an arm's length management company that can follow industry standards and charge the same management fee that other similarly situated companies follow. And then you can have that management company earn a lot of income and be partly owned by a 678 trust that does not have to be owned by a doctor, does not have to be owned by a lawyer. So we're going to cover that later, but I just think one thing Jerry Hesh taught me, if he taught me anything, is keep saying the same thing over and over, and maybe at the end of the program, somebody will remember what the heck you said. So that brings us to polling question number 2. And which of the following webinars would you like to attend for free? And if you choose one of these, I warn you, we will enroll you for free. But you could also choose D, heck no, I won't go. A is everything Brandon and I know about the employee retention credit and a few things we still don't know. B is superpowered philanthropy with 501c4 organizations with Carl Mill, who is so brilliant in this area. I just love listening to Carl Mill because the words just flow out of him like poetry. But it's the 501c4 organizations, very, very interesting. And then year-end tax planning with Jonathan Blotmacher and Marty Shinkman, and I get to help lead that discussion to keep those guys out of trouble, because that's where they head every time if they don't have adult supervision. So just choose one of those, and we will make sure that we enroll you, and we thank you for answering. Did that go over, or did it bomb? All right, it bombed. We're sorry. Okay, Brandon, back to page 46.
Yeah, so these are, again, kind of echoing what Alan was mentioning earlier. What types of entities can own S corporations, or what types of trusts can own S corporations? This can be important as part of our 199A planning, because the last thing we want to do is try to shift income out of the S corporation to get other thresholds and qualify for the deduction, and then blow the S election. So we got to be careful there, making sure we have the right types of trust involved. And then this is just good background knowledge in general to know what can an S corporation, or who can own an S corporation, or what can own an S corporation. So starting on the left and working across, we have grantor trust. That's your SLATs, your spousal limited access trust, GRATs, grantor retained annuity trust, or just a regular old basic grantor trust, where the grantor pays the income tax on that type of trust. Disregarded LLCs can own S corporation stock, but you got to be really careful there, because the minute someone other than the current owner makes a contribution to that LLC, it becomes a partnership, which is an eligible S corporation shareholder, and now you've blown the S election. There's savings clauses you can use to try to help yourself out there, such as there'll be no other contributions. It's treated as a loan, but just be very careful with the use of disregarded LLCs owning S corp stock. Charities can own S corps. Alan, you want to chime in there? Sorry.
Yeah, I'm sorry I interrupted you, but I just want to point out there's a couple of errors on the slide. This is an older slide, and Brittany, please remind us to fix it. But IRAs can own S corporation stock now, but pension plans cannot. So number 4 in the box there isn't correct. And then I observed the passing of Elvis the dog. Marty Shinkman's dog, Elvis, did pass away. We'll have to put his next pet, or maybe we'll put Larry's king snake in there. But
there we go.
Not own S corporation stock. And I apologize for interrupting you again.
No, you're okay. So charities can own S corporations, and you'll see in the bottom right box there, charitable remainder trusts cannot own S corporation stock. So a lot of times you might consider the use of one of those charitable remainder trusts on the sale of a business. If it's an S corporation, you can't do it that way. It's got to be done another way. The 678 trust that Alan spoke of earlier, that's okay as an S corporation shareholder. Complex trusts are okay, but it's got to be an SBIT trust making an election, or a QUIS that also makes an election. So you can't just stick it in the complex trust. There's got to be an affirmative election made there to have proper ownership of an S corporation company. We have some more information here about SBITs and QUIS. I'm going to kind of just roll through this so we can get to some of the more relevant 199A planning. So one of the things too to make sure we mentioned is these anti-abuse rules. So when 199A first came out, we said, oh, this will be easy, right? We'll just set up 10 complex trusts, and if we have $1 million of income, give each one 100 grand, and we'll be fine. No one's over the threshold, everyone will qualify. Well, the IRS is smarter than us in a lot of ways sometimes, and they came out with these anti-abuse rules that says when you establish a trust, the principal purpose of which is avoiding or using more than one threshold amount for the 199A deduction, then we're just not going to respect that trust as a separate entity. So how does that exactly work? Well, here we have an example where we have mom owning an SSTB that has $400,000 of income, no deduction. Well, if she gave half to the son, now mom has 200,000, son has 200,000, everyone's eligible for 199A. What if we used a trust in that same situation? Maybe there's other purposes for this trust that we could come up with where we don't have to avoid the anti-abuse rules, but let's just say for sake of example, there's no real reason for it. We just wanted the additional threshold amount. So we give the trust half, mom keeps half. The trust distributes $100,000 of income to the son, retains $100,000 of income. So at first glance, you think everyone qualifies, but because of this anti-abuse rule, everything's aggregated together. So there's $400,000 of income for the purposes of 199A threshold amounts. No one gets the 199A deduction. So we got to be careful about planning and what we can do here. So I'm going to skip forward just a little bit to get to.
Yeah, we could do a part 2 on 199A.
Yeah.
If you're watching this and you want us to do a part 2, just let us know and we'll do a part 2.
So the question is, what's the primary purpose, right? How can we avoid it being the primary purpose? So if we looked at some definitions, we looked at some old case law, and it says if there are 2 or more reasons for a particular action, then they all have to be exactly equal for them to be primary purposes. Or if one purpose has a greater score than any other purpose, then that can only be the primary purpose. So, a lot of these trusts we do for estate planning reasons, we do for creditor protection reasons, we do some for tax planning, but is it really the primary purpose? Maybe not. So there's ways you can document your file to make sure that we are documenting that these trusts weren't set up for the primary purposes of avoiding 199A, that it was just done for other reasons. And 199A might have been a reason why, yes, it's a good benefit, but it wasn't the primary purpose. The other thing that also came out in the anti-abuse rules was trust aggregation. And if you have 3 trusts with the same grantor, the same beneficiaries, and the principal purpose of which was avoiding tax, those are all going to be lumped together as one single trust rather than 3 separate trusts. But there's rules there that apply with respect to that. So if you have different beneficiaries, you're outside of this rule. If you have trust 1 for one child, trust 2 for the other child, those can't be aggregated together because they're not the same primary beneficiaries. So there's different ways to work around these rules. And I think there's a polling question here as well. Polling question number 3 that we can get to.
Who's that? You know what page it's on? 77. Something just happened with this PowerPoint. Oops. What am I doing now? Brandon, you want to?
Yeah, I was going to.
Yeah.
Let me get you back on the right track.
Experiencing technical difficulties. Please do not touch your television set.
Yeah.
All right, polling question. Trusts will be aggregated as a single trust for 199A purposes if A, the trusts have the same grantor, B, the trusts have the same beneficiaries, C, the principal purpose of the trust is the avoidance of income tax, and D, all of the above. And the correct answer, as always, is all of the above. Brittany? Okay, fast crowd. What's next, Brandon?
All right, let's go to slide 83.
By the way, a lot of people want us to do part 2. Should we just start part 2 now?
Sure.
This is part 1. Okay, all of you who wanted part 2, this will be part 2 starting right now. And then we'll do part 3 next time.
So this is one of the planning kind of examples of what we could possibly do. We have a medical practice S corporation. It's owned by the married couple. It's got $4 million of income. So clearly, no 199A deductions available here. Well, they have 3 children, and they came into the office and they wanted to set up trusts for the 3 children and gift part ownership of the medical practice to those trusts for estate tax planning. Well, we said we can also help you out for income tax planning with Section 199A. This would be even better if these trusts were formed previously before 199A. They were already in existence. Then we don't even have to worry about the rule that they were created for the primary purposes of getting another threshold, because they were in existence prior to 199A. So that's what can we do with these trusts? Well, number one, if you're in a state where the trust can own the medical practice, maybe there's a sub-trust where the doctor is the trustee of that trust that holds the actual ownership of the medical practice, and then the actual trust for the children is above that sub-trust with a different trustee, so it's outside of the estate. And then the medical practice income can flow to that trust. They can make distributions to the beneficiaries of the trust based upon their income level to not get them over the threshold amount for 199A. It can retain income itself to not be over the threshold amount for 199A. So if we gave the medical practice 10% ownership of each of those trusts, then each one would have, roughly $280,000 of income here based upon the income level in this example. And then everyone qualifies for the Section 199A threshold. So you've been able to shift out a good amount of income from Dr. Jones and get the Section 199A deduction, and everyone's happy. What happens if the trust can't own a medical practice, or if it's a law office or an accounting firm and you have to have an actual professional owning the entity? Well, as Alan mentioned, you can set up a management company, pay a management fee for managing that entity. There's all kinds of comparables out there that you can use to kind of see what the price of this management might be, make sure it's fair market value, and then you pay a management fee over, you have some expenses, you're left with a net income amount. That's also going to be an SSTB because of those aggregation rules that say if you provide services to an SSTB and you're commonly owned, including attribution rules, which would include these types of trusts, then we're also going to treat the management company as an SSTB. But if the complex trusts or the children are under the threshold amounts, then we're good, because it doesn't matter if it's an SSTB, we're under the threshold. So Alan, you want to talk a little bit more about the management company and how that could work and how you set that up?
Yeah, thank you. So first of all, this is a Florida specific slide because we've been told by the Florida Agency for Healthcare Administration that our statute, which basically says that you can have a medical practice owned by a doctor's spouse, or a doctor's child without having to register it under the Clinic Act. So we said, well, what about a trust for the doctor's spouse and child or children? And they said that's fine as long as the doctor is the trustee of the trust. So what you have here is a complex 678 trust, and the 678 trust, the doctor is the trustee but has no discretion, because the 678 trust, the doctor would be trustee of a land trust, just a very simple trust owned by a 678 trust. So the trustee of the 678 trust could be a child, CPA, lawyer, not the spouse, because if you have your spouse as the trustee of a 678 trust, it's not a 678 trust, it's a grantor trust. So this is a spousal limited access trust, and again, taxed at the bracket of one of the children or one of the grandchildren, but can make distributions to the physician's spouse. That is Florida specific. But what's not Florida specific is the management company. Now, I get very queasy a lot of times when a client comes to me, usually a new client, and says, well, I have this management company. My CPA set it up on the internet and it gets $1 million a year of management fees. And we do this and we do that. Well, is it at arm's length? What does the company actually do? Well, I just told you what it does. It receives $1 million a year in management fees. Okay, well, how does it earn that? Well, it doesn't. I don't know. CPA said it's okay. Don't tell them it's okay. Under Internal Revenue Code Section 482, you're not supposed to overpay an entity. So, but in the physician practice management world, as many of you know, there is a standard in the industry where a doctor who is earning $1 million a year, but the average doctor in his category earns $400,000 a year. So the difference is $600,000 a year. And you could buy his practice for maybe 600,000 times 5 times, $3 million, and then pay him 400,000 a year. And the practice management company earns 600,000 a year managing the practice. And that's at arm's length. They happen all the time. So we set up the management company, have the management company receive as a gift from the doctor an arm's length management arrangement, file a gift tax return, show that as a gift, and now you have a legitimate management company earning legitimate income. You also have to watch out for 269A. There is an article on this that Jonathan Blottmacher, Marty Shinkman, and I wrote for Limeberg. I'm glad to share that with you. But it is a nice little way to reduce income taxes for professionals while also funding spousal limited access trusts, which are good for estate tax purposes and also incidentally good for creditor protection purposes. So thanks for listening to that.
All right, let's see.
And then Brandon, I think we probably ought to leave 5 minutes for questions and answers.
Sure.
You want to take a look at some of these questions and answers before we go to Larry, who will start at noon and show us tiger tables, which will be absolutely amazing, not to mention also a king snake. But the last polling question, and I thank Matt Poling, who's a real estate lawyer in Tampa, for helping me with a matter last week, which will be true in 2023. According to many, the estate tax exemption will increase with the consumer price with chained inflation index to $12,920,000, and I'm sure Larry will be able to correct what I just said. And then the annual gift tax exclusion, the amount that I can give my granddaughter every year, is going from $16,000 to $17,000 next year. So that's all happening. The correct answer is all of the above, and you got it exactly right. Thank you very much. All right. Nothing funny there, though, actually. Brandon, anything you want to say at the end here, or do you want to cover questions and answers, or do you want to dance and sing?
Yeah, I saw one good question. Let's see if I can find it again. It was basically asking about if the trust distributes all income, does the 199A in character flow through? And the answer is yes. So you have, the trust itself is receiving Section 199A income. It keeps $100,000 of that. That's Section 199A income. The trust gets to the deduction because it's under the threshold amount. It distributes another $100,000 out to the beneficiary. They're under the threshold. That $100,000 is still qualified business income, eligible for the Section 199A deduction. So the trust doesn't taint anything. The trust just, flows it out as it comes to the trust and keeps the same character. Let's see.
Here's a good question. I got some good IRA questions on S corps, which are not under 199A. But the first thing is, can an active company under an S corp be owned by an IRA? And the answer is, I'm not sure, but it could be owned by a 401k. It's called an ROBS. I don't encourage anyone to own a business under an IRA, but when you have a client that has judgments against them and they want to start a business, keep that IRA there, convert it to a 401k and do an ROBS and be really careful. And then another question is there a bank that will allow you to have your IRA own an S corp? No, but there are private custodians. There are reputable custodian companies that would allow your IRA to own S Corp stock? And then does that cause unrelated business taxable income issues? That's a great question. I'm going to check that out and send everyone an email, but I don't think it does. Otherwise, that would be in our 199A book, because we were very smart in 2019 when we wrote that book. I just don't remember right now. Okay, who pays the ventriloquist? No one pays the ventriloquist. That's why he's not very good. What else, Brandon?
Yeah, here's a good one. If there's a house in a grantor trust and it's being sold, can you take the $250,000 or $500,000 gain exclusion? Yes, you can, because the trust is basically non-existent for income tax purposes. It's the grantor of the trust treated as holding the assets directly for income tax purposes. So you still get that 121 gain exclusion of $250,000 or $500 for a married couple.
Oh, well, if the grantor lives in the house.
Yes, it's still got to be your primary residence. Yes.
If it's a 78 trust, then that child lives in the house. And that's why we have a lot of clients start the 678 trust when the child goes to college and the parents foolishly say, oh, let's buy a house next to the college. And that works really well in a 678 trust if real estate goes up in value. Real estate goes down in value, then not so much.
Let's see. I think I don't see any other.
Oh,
so we have a question here about grantor trust that also has crummy powers. Will that be a good S corporation shareholder? And the answer is yes, because if it's a grantor trust, the crummy powers don't necessarily make it a grantor trust, but you can still have those, and that's basically the right to withdraw assets up to a certain amount, generally limited to the gift tax exclusion. But yeah, that would be a fine S corporation shareholder. Brings us to the other point on 678 trust, which we didn't really get to go into a whole lot of detail on today, but we'll definitely hit those heavily in part 2, is giving that beneficiary the right to withdraw either all of the income annually or all of the trust. You can trigger that trust to make it taxable to the beneficiary rather than the grantor or the trust itself. And so that's how you set the 678 trust up, is you give them essentially a crummy power to withdraw all the income annually, and that triggers the income being taxed to the beneficiary. Well, here's another good one. As far as I know, only a grantor trust can take Section 179. Why do I want to do this? Well, you're exactly right. The complex, so trust cannot take Section 179 deductions, but they can take bonus depreciation, 168K. There's nothing that stops them there. So you can almost get the equivalent under 168K for certain things. But the idea too is to, all these things, it's as simple to say, yeah, I'll set up a trust for 199A planning and get another 20% deduction on a threshold amount. But there's you have to look at the whole picture, right? If Section 179 is important, then maybe it's not as important for the 199A deduction. Maybe you care more about your 179 deduction. So don't just do one thing because it looks great. Think about how that impacts the full picture. Again, run the numbers, run math, make sure a lot of times we think something makes sense, you run it out and it doesn't. You say, okay, never mind, bad idea, let's try something else. So I think that's a good point to, don't limit yourself by making assumptions.
Okay, another question is, when will our 199A book be updated? And it's not going to be that hard to update the book, Brandon. I think Peter's already gone through it and changed all the numbers throughout. So that's a great question. We'll try to get it updated. If you want to be a beta reader to see where we are right now, just send us an email with the words beta, B-E-T-A, and we will send you either a PDF of the book as it stands now or a fish, depending upon which you want. I don't think the beta fish do well in the mail, but you could find out. By the way, when I was 5 years old in 1965, my grandfather mailed me an alligator in a box, and it did not survive. So I don't recommend that you ever do that. In fact, that would be a huge federal fine right now, but he did that, so I wanted to mention it. All right, now I have really been waiting for this, and we had originally invited Larry to join us, which turned out to be the weekend after a hurricane. So we had to cancel that. And here he is with us today. If you don't know who Larry Katzenstein is, then you are not a tax lawyer or an estate planning lawyer. Because if you are a tax lawyer or an estate planning lawyer, you remember that when you took your first test, they said, who is Larry Katzenstein? And you had to answer that, the inventor of tiger tables and a very eloquent and mathematical guy. So when I started practicing in 1984, Larry was a leading authority and also has an interesting story to tell about how tiger tables came into being. So Larry, welcome. We're so glad to have you, and the stage is yours.
Thank you. How did tiger tables get started? I guess it got started because in my, let me call up something on my screen here. I guess it started because in 1985, I got my first IBM PC. It had 2 floppy drives, no hard drive, and I wanted to learn how to do things with it. So I thought, well, it can't be that hard to write a program. I mean, look how many programs are out there. So I bought the first version of Microsoft Basic and played around with that a little bit. And then Borland brought out his first version of Turbo Pascal, which is really a fabulous language. And it's not used as much as it used to. It's been replaced by things like Python, which is another great language for people who never programmed before. So then I had this program, and I thought, what can I program with it? And so the first things I did, and computers weren't very powerful then, so this wasn't very successful. I wrote a program to look for prime numbers, what are called Mersenne primes. That was kind of fun, but not very useful. I wrote a program to calculate for the next 2,000 years what day of the week Easter would fall on, which is a very complicated formula that I could never have figured out myself, but it was fun to program it. And then I saw an actuarial formula in the regulations under section 170A, which is the section that deals with the remainder in a residence, which is given to charity, and it tells you how to compute the factor for the depreciable property. And I looked at that formula. I said, I wonder if I could figure out how to program that. That might be kind of fun, because there was no way of doing a 2-life calculation of that. You had, because there are too many variables. You had interest rate and your age, 2 ages, and depreciable life. And so that was probably one of the first things I programmed. Anyway, let me just go through my little introductory PowerPoint here and tell you a little bit about what goes behind actuarial calculations in the first place. And I remind you, I'm an amateur actuary, just as I'm an amateur programmer. So my knowledge of this is only deep enough to do what I needed to do to write the program. But what goes into actuarial calculations is really just 2 things: interest rate assumptions and probabilities of survival. Now, some calculations involve only interest calculations. Some involve only mortality assumptions. And if all you're doing is something that involves interest or mortality without combining the 2, you don't need a calculator. You don't need a software. You just need a calculator. For example, let's suppose I want to find out what the remainder is after a term of years. You could do this at home without a computer. If you just take 1 divided by 1 plus the interest rate, take it to the power of the number of years of the term, and that's the remainder. So for example, if I want to know what's the value of the right to receive $1 in 10 years, assuming an 8% interest rate, I take 1, add it to the interest rate, that's 1.04, divide that into 1, you get 0.925926. Take that to the 10th, which you could do on your calculator, and you get the remainder, which is 0.463193. The income interest is simply 1 minus the remainder. The income and the remainder have got to add up to 1. And to calculate the annuity value, you just take that income factor we saw before, that 5,36807, divide that by the interest rate of 8%, and you get the annuity factor of 6.7101. It's very simple. Some calculations involve only mortality. For example, if I want to know what the probability of surviving from one age to another age is, I take what's called an LX number. That's taken for this chart. The LX table shows the number of people living at every age from 0 to 109. And if I want to know what the probability of surviving from one age to the other age is, I just take the older age number and divide it into the younger one. So for example, the probability of a person who's a newborn surviving to age 15 is 98.998%. What gets complicated is if you have to combine interest assumptions and mortality assumptions. And this is the formula for a one life remainder. And as I say here, do not try this at home without a little supervision, because this gets much more complicated. And for example, if you were doing it on a spreadsheet, here's just a little piece of the spreadsheet that will calculate that. And so it's for this kind of a calculation that most people will really need to use software rather than to do it on a spreadsheet. And I have the columns here. This would have to be carried out through the end of the mortality table, which runs out with the last age at 109. So what is Tiger Tables? And I'll show you how that works. And you're going to get to see here the newest version, which I have not released yet. This will be the version that will get released once we know the effective date of the new mortality assumptions. And the reason that's important is, and I'll just go to, for example, the simplest calculation, the term of years, rather the life estate. When I put in the date of the transaction, it defaults to the correct mortality table. And until I know the effective date of the new tables, I can't do that. The proposed regulations said that the new tables could be used for any transaction in 2021 or 2022, but in the comments that were submitted by ACTEC, which I wrote for ACTEC, we pointed out that the statute, section 7520, actually mandates that they use, that they update the tables every 10 years, and that would have been May 2019. So I think that there's some chance they may, in fact, do that. So until I know the effective date, I'm not going to release the newest version of the program. So let me just go through and show you some of the features of the program. Some of them are very simple. This is simply the term of years factor we talked about before. So I'll put in 8%, I'll put in 10 years, and I'll calculate the value of the remainder. Over here you see the annuity adjustment. If you want to change it to a quarterly payout for the annuity, you can do that. You don't have to worry about frequency of payment with an income interest, because undistributed income will also earn income. So you're not disadvantaged by getting paid income later in the year or earlier in the year. Some of the things that are less common, besides just simple term and life estates, are combinations of things. For example, this is the calculation for the value of an annuity or income for a term of years or until the prior death of a person. So again, we'll use the current interest rate, which it will pick for you. You don't have to put that in. Let's say it's 10 years and the person is 70. And this is what the values are. If you want to use one of the earlier mortality tables, you can do that. And you can go all the way back to the first tables which came out with the first version in 1989. Here's the value of a reversion. What's the probability of a death occurring? What's the value of $1 of a death to be received on the death of a person, provided the death occurs within a certain number of years? So again, let's just use 4%, and let's say the term is 10 years, and say the person is 70, and you can see the value of that reversion is 0.21702. That's the value of the right to receive $1 at the death of a 70-year-old person, assuming they die within 10 years. Now, what would have happened if you had done this back here? You would expect the reversion to be much higher, because people live a lot longer now than they did under the previous tables. And you can see the reversion goes from 0.21 up to 30%.
So Larry, let me ask you on that one.
Sure.
So I could design a trust where my client is not a beneficiary of the trust unless his children die before him.
Yep, exactly.
And then under the Internal Revenue Code, that's okay as long as his right of reversion is less than 5%.
That's right. That's right.
So, and can you assume normal health, that his 2 children would be of normal health, and then you could ask your program whether that will fit or not?
You can assume that as long as you don't know that they have some condition. The regulations say that you have to use these mortality tables unless there's more than a 50% chance that the person will die within a year.
Okay. Could
And
I
if
put a
five, a year and a half, then they're presumed that you do meet that test.
Yeah. Could I put a savings clause in the trust agreement that says, just in case the probability is more than 5%, only a portion of the trust will come back to the grantor?
Yeah, you can do that. You can do that.
Okay. All right. Good. I've always wondered about that.
And then here I have factors for the value of the income or annuity for a term of years or until the second to die of 2 persons. And here I have the same thing for that calculation of the value of income or annuity for a term until the first to die of 2 persons.
Okay, so when would Larry, when would somebody use that particular application? If you go back to life and term, when would somebody use that?
I guess if you had a trust or a trust that said that certain things happen depending on order of deaths, and you needed to know that for previously taxed property credit purposes or some other purpose, maybe for gift purposes, someone's giving away their interest in a trust, you need to know what the value of their interest is.
Okay, right.
Let me go on to some of the charitable factors. I have charitable gift annuities, and here is something I think I will illustrate that you'll find interesting. Again, let's go to the current interest rate. And here you will see that you have 3 rates that are given to you. And that's because if a charitable deduction is available, then you can choose either the interest rate of the transaction, that's the October rate, or one of the 2 prior months. And here is something interesting about gift annuities that I don't think people consider enough. Let's put in the age 70 donor. Let's put in $100,000. And I'm not gonna look up what the CGA rate is at age 70. Let's just say it's 5%. And let's say the person wants to be paid quarterly and they're funding it with cash. You can see that the deduction is $45,677. Now the program showed you that this was the best rate to use, but that is assuming they want a higher income tax deduction. With a gift annuity, though, many people don't itemize. Many older people don't have any deductions anymore other than state and local income tax, and that's now capped at $10,000. So for a person who doesn't itemize, they might be better off using the lower rate. And the reason for that is that the amount of each payment which is taxable will be less. It goes from 68.3 to 70. So 70% of that payment will be excluded. So I think charities need to ask their donors when they're taking out gift annuities, does this donor of yours itemize or not? And if they do itemize and want a larger deduction, then they should use the higher interest rate. If they want a higher amount of each payment excluded from income, then they should check the lower rate.
Okay, so let me go back to that.
Sure.
Okay, just want to, because we have a lot of non-lawyers, non-CPAs on this, so I want to try to make sure they have a chance to understand what this is. So
Okay.
if you're on a charitable board, you could accept a payment, and I believe it can be in cash or it could be appreciated stock or other assets, and say, give me $100,000 and you are age 70, and I will give you $5,000 a year for the rest of your life, and you will also get a charitable deduction.
Yeah. You get a charitable deduction, a portion of the gift, again, assuming you itemize, and a portion of each payment will be excluded for the rest of your life as just like a commercial annuity. And most charities that are sizable issue gift annuities. The gift annuities, the oldest of all the planned gifts. Most charities issue rates that are recommended by the American Council on Gift Annuities. Those are maximum rates. You can always offer a lesser annuity and then the donor will get a higher deduction. So the gift annuity is a very popular tool. And one reason it's so popular is that because there's no trust to administer, charities will often issue them for very small amounts, 5,000 or 10,000 even. They usually have a minimum age, of course. 60 is pretty common. Some a little older, some a little less, but they're a very popular gift, and it's often an introduction to planned giving for donors. Among the other charitable tools, I have charitable remainder trusts. Everybody knows how those work. Again, we'll just put in
So
two
for the
lines.
layman, yeah, and for the layman, a charitable remainder trust is you set up your own trust. You could be the trustee. You put $100,000 in the trust. The trust is going to pay you 5% of the value of the trust assets every year for a term of years.
Right.
And what Gary's put in here is that it's going to be two people, their ages 70 and 75, and it's going to pay until the death of the survivor. So this could be a married couple, age 75 and 70. They put $100,000 appreciated stock into this trust. They are the trustees. They're going to get 5% of the value each year, and they get a charitable deduction of $42,480.
Yeah. Now that's under the new mortality tables. Under the tables before now, it would have been a higher deduction because people live longer under the new tables, and so their deduction is less. And if you do a charitable remainder trust now, before the new tables come out, you can still use the old tables. Let me show you a couple of interesting things about charitable remainder trust. And incidentally, I don't usually recommend clients be their own trustee of these. You know, if you do them with a sizable charity, the charity will often serve as trustee, which is much better. There's so many traps to serve as your own trustee. So although, as you point out, it can be done, I don't recommend it. Now, let me show you a couple interesting things here. Let's say that the payment was made annually, and the valuation date's the same as the payment date. Now, here's my deduction, $44,000. What happens if I change the interest rate to 10%? You want to guess, Alan?
A big difference.
Actually, the answer is no difference at all, because a unit trust is very insensitive to interest rates. If I have a unit trust paid annually and there's no gap between valuation date and payment date, the interest rate is totally irrelevant. And that's because if you think about it, if the trust grows in value, let's say it doubles in value, my income interest will be twice as much and the remainder will be twice as much. They rise and fall in tandem. The only effect of interest rates is if you're paying more frequently than annually, or if you're paying, if there's a gap between valuation date and payment date, then there's a little bit of an effect. And you can see the change was very modest in just going from annual to quarterly. So one other thing I want to show you that's interesting about the new tables, and let's change it to interest rate that's more like what we have now. Under the proposed regulations, they tell you you can calculate the remainder in a charitable remainder trust using either an interpolated method or an exact method. Now, before we had actual computers to do this for us, we had to use an interpolated method, because when you adjust the payout rate to take into account the table F adjustment factor, because you're paying it quarterly, for example, rather than annually, then you have a payout rate of 4.8, you know, an odd number. And the only way that with published tables you could calculate that would be by taking the published rate at 4.8 and then one at 5 and interpolating between them. So that's the way we've always done it before. But actually, if you do it exactly, that's a more exact number, and the new regulations as proposed give you an option to do that. Now, what's interesting about it is I don't think anyone will ever use this. And the reason is that the exact calculation will always give you a little bit lower deduction than the interpolated method. So when you create the trust, people will use the same old interpolated method we always did. If later they decide they want to give away their remaining income interest, then they will still have to use the interpolated method, because you have to be consistent. You have to use the same method for calculating the income and the remainder. The only place maybe this will be used will be on lead unit trusts, which aren't very common, because most lead trusts are annuity trusts. but maybe for generation skipping planning, people will do them there. Let me try to go quickly through some of the others because I don't want to run out of time. I pulled income factors.
Take your time. You can always come back later. So
Yeah, I have the remainder of an interest in a personal residence to charity. This is the one that got me started programming because I thought it'd be fun to program this. So for example, if I have 2 lives and it's 65 and 70, and we'll assume the real estate, the house part has a depreciable life of 45 years. And let's say that half of the value of the $1 million house is, $1 million house is land and half is building. And you get a very sizable charitable deduction, as you can see here.
So this is if you have a home or a farm and you're willing to give the charity the remainder interest, and you'll live in the home for the rest of your life.
Right.
You'll get Uncle Sam will write you a big check for
That's
almost 40, he'll write you a check for 120 grand for making this promise, and then your children can't take this home away from you.
Yeah, and this is a particularly good gift when interest rates are low because the use of the house is kind of equivalent to an income stream. So if the interest rate was 8%, you could see the deduction would be much smaller. Now, let me show you one other thing that's interesting. With the depreciable property, you get a smaller deduction. But a lot of houses in suburbs, certainly true where I live, a lot of the houses are really tear downs. They're really valuable for the lot. So let's say the house was only worth 100,000 and the land was worth 900,000. Now watch what that does to the deduction. Very dramatic increase in that deduction. So a couple of other things in charitable. I do charitable lead trust, and here's the most interesting thing about lead trust I want to show you, which is the shark fin lead trust. So again, let's use the current interest rate, and I'm going to use here. We want to use a lower interest rate, and let's do a shark fin trust. Make it 10 years. The shark fin trust is simply a lead trust that has a big balloon payment at the end. You know, with grants, which are kind of mathematically equivalent, where you get an annuity and you have to beat the interest rate. Here, the annuity goes to charity instead, and there is no 20% maximum increase, so you can have small payments at first, and you can have a big payment at the end. And let's say I put in $10 million, and I'm going to show you that we'll assume first that the assets actually grow at the 75/20 rate. Now we enter the shark fin payments. And let's say I want to really backload it. I'll put in my $10 million trust. We're only going to pay $20,000 a year, maybe increase a little bit every year. And now I want to figure out what that balloon payment would be at the end. I just click to zero it out. That's what the balloon payment would be. And if you look at the economic results, you can see that's right. I left with $1 at the end. It didn't. 1 penny at the end. It didn't perform. If I can do better than the 75/20 rate, then I have 3.6 million left. And with every single calculation, you can print it out. Here's what the printout looks like. You can save it as a PDF if you want to as well up here, or you can print it. So,
Larry, for the layman, let me just try to simplify this. You put $10 million in a trust, and you get a $10 million tax deduction. Then for the 10 years, you pay income tax on the income of the trust, and the trust makes the payments that he showed you to your favorite charity. And then at the end of 10 years, what's left in that trust can go to your children, estate and gift tax free.
Yeah, it really works just like a grant. With the grantor, with the lead trust, if you want an income tax deduction, it has to be a grantor trust, which, as you said, you then taxed on all the income. You can also do it as a non-grantor trust. Then you don't get an income tax deduction, but you're not taxed on the income. So
now, Larry, I think most planners are using an annual equal payment or a payment that increases by 20% a year. How comfortable are you with the shark fin payment schedule?
I'm very comfortable with it. The regulations, I think, make that clear. As long as it can be calculated, you can have whatever payment sequence you want. And
Wow.
the other thing you could do if you wanted to, you could put any kind of random numbers in here. They don't have to increase at a set rate. You could have, $5 for the first year and $800,000 for the next year, and you can put whatever numbers you want. And then it will still, though, at the end, let you calculate what that zeroed amount is. And I hope you like my little shark here.
Yeah, he's cute.
Grats and Cupers, you know how they work. I don't need to show you how a grat works, but it's the same idea we saw before. I do have qualified personal residence trusts. You all know about those. I don't need to show you much about those. Let's say it's a.
Well, do show us though, because I think
Okay.
the layman here, this is a trust where you put your home in the trust and you have the right to live in the home for a term of years. And it's a gift when you put the home in the trust, but it's not a gift of the whole value of the home. It's only in this situation a gift of 64% of the value of the home.
That's right.
So you put $1 million home into this trust, you are making a $643,000 gift, but then the entire value of the home is out of your estate as long as the two people live past the 10th year. So
Yes.
you have another screen that shows the savings?
Well, the savings is you're making a gift of only $629,000 for $1 million house.
Right. But
Oh,
then,
yeah.
but in
Yep.
10 years, it'll be worth 2 million. And
Yeah. I don't have that in because that's totally speculative. It'll be whatever it's worth. If it's worth 2 million, you still made only a gift of 629,000. One other thing about the Cupid I'll point out is that look what happens when you change it to the new mortality assumptions. It doesn't change it very much. It goes from 0.62 to 0.64. Why is that? Well, because remember, people live longer under the new tables. So that means that the retained income is worth more, but the reversion is worth less because there's less chance they'll die in the term. So the new mortality tables don't make as much difference to a Cupid as you would expect because these things kind of work in opposite directions.
Larry, have you ever, when I run the numbers on a shorter Cupid and I show the rent that the client is going to have to pay to the Cupid after the term, it almost seems like a shorter term is better than a longer term.
Yeah, it may be, and it certainly cuts down the risk of mortality.
Yeah. And then when you have a married couple, do you normally do one Cupid like you just showed? Because we typically do one Cupid by each spouse so that one of them can be a slat, so one spouse can benefit from the other.
I've done it both ways.
Yeah.
Yeah, I have a number of probabilities of survival things. If you want life expectancy, I don't find that very useful for planning because life expectancies really tell you in a group of 100,000 what life expectancy is. It doesn't mean much with a population of 1. Here is the LX table, and this shows the number of people living at every age from 0 to 109. And you'll notice something different in the proposed regulations. These are the new tables that will be effective one of these days. And if you compare them to the old table, you can see there are no decimal points. But now they have added decimal points to the LX values. Now that may seem odd in a way because this tells you how many people are alive at every age from 0 to 109. How can you have 28.28 of a person alive? But I guess when you take big numbers and add them up, you get those kind of funny things going on there.
Okay, so Larry, can you go back to that?
Sure.
So a person who's just born has about a 57% chance of living to age 80 based on these tables. But these tables include people who smoke and people who don't take care of themselves. Our clients, typically are better educated than the normal population and get better medical care than the normal population. So what does that tell us? What kind of a variation is there between the tables and reality?
Well, there's a lot. For one thing, they're unisex. We used to have separate sex mortality tables. Women live longer than men, but we don't take those into account. And remember, these tables are out there so that people can deal with a tax system that gives you certain tax treatments for certain transactions. And they just, as a practical matter, can't have a separate table for smokers and for women and for people with high blood pressure and so forth. They're averages. and they're rough justice for a tax system, but they're not the tables you would use for designing a pension plan, for example. You better know whether more of your employees are men or women, because that's going to affect your pension obligations. But for calculating what your deduction is in a charitable remainder trust, this is rough justice. But no, you're absolutely right. It doesn't take into account any of those kinds of things. Probability of living from one age to another age. Again, this is not useful with the population of one, but it's useful when you're doing some various actuarial calculations. I've got the probability that one person will survive another person, the value at age X of $1 at age Y, the value of $1 if one person survives another person. These are sometimes valuable if you're trying to figure out interest in a trust for gift tax purposes, maybe where someone's going to give up an interest in a trust, or maybe the trust is includable under 2033 for some reason, and you need to determine that value. So this might be where you would use this. I've used it a few times where I had to calculate what the probability, or what the value rather it was of an interest that could only vest if they survived another person. So that's sometimes useful. Here's the probability one person will survive another person. So what do you think the probability is? 65-year-old will survive another 65-year-old. What would you guess the probability is?
50%.
There it is, 50%. And if the person was 70, let's say, what's the probability a person age 70 will survive a 5-year-old? Tiny. What's the probability the 5-year-old will survive the 7-year-old? It's the inverse of that.
Wow.
But it's really interesting when you look at these tables, how much longer people live now than they used to. I have one other thing in here which nobody will probably ever use, which are what are called commutation tables. And this is what we used to have to use in the old days before computers, when you wanted to calculate values of interest and term of years in combination. But nobody will use these anymore, but the IRS still publishes them, so I do calculate them here. This is another one that can be really useful. What's the value of an income interest plus the right to withdraw 5% or 5,000 at 5 or 5 power? And this could be useful for PTP credit purposes. If someone dies and they had an interest in a trust and they get a previously taxed property credit for that, having the 5% withdrawal right can really increase the value of that interest. So there's the value of the interest with a 5% withdrawal right.
Wow.
I also have private annuities, self-canceling installment notes. I'm going to go on to something else here. Often we need to calculate the number of days between dates, and this will let you do that. So if I want to see the difference between the number of days between, let's see, there's the number of days, and I can include the last day in the count if I want to. Probably not necessarily, people could add one if they wanted to, but I have it there. And this is something I found really useful. When we calculate a deduction in a charitable remainder trust or use these tables in any other way, we need to use the nearest age. And so before, I would always get out my calendar, I would count the number of days in March and the number of days in April and actually count them up. But this lets you do it on the fly. You can just, if I want to know the number, say my person was born on May 8th, 1954, and I'm going to do a transaction. Let's say the transaction was going to be last month in September on this date. Here's the nearest age. Calculates that for you without having to haul out your calendar and actually count number of days.
Nice.
So I found that one actually very useful. I have something else here, which is if you have created a charitable remainder unit trust, or you've created a GRAT, and I die, part of that will be included in my estate, but not all of it necessarily. And this will calculate how much is includable. I also have, following what the regulations provide, how much of a graduated GRAT will be includable. Yeah, and it may be that if the interest rate at death is much higher than the interest rate when you created the grant, that not all of the grant will be includable. And so this will calculate that for you. And this, the regulations show how to do that calculation, but here it does it for you. I have a prior gift calculator. So let's say that I have, maybe I'll just put a bunch of random gifts in here. I'll put a $7 million gift here. And let's assume this is the year I'm doing my calculation. So here's the prior gifts that are shown. It shows how much additional gifts can be made this year without tax, because I've actually paid some tax in prior years. And as always, if I want to print that out, that's just like the table that's in the gift tax, the estate tax return. Let me go back and add a few more gifts here. Let's add a $5 million gift here, and maybe I made a $2 million gift here. There's it shows I still can make 44,720,000 of gifts. Now let's say I'm going to calculate my estate tax return. This will transfer that to my estate tax calculations.
Wow.
And remember that you have to, you can't use the amount of gift tax that was actually paid when this was done originally, because you have to recalculate the gift tax using current year rates.
That's amazing. I didn't realize. Very
The other
nice.
thing it will do for you is it will calculate interrelated calculations. So let's say that 20% goes to charity. Well, that's an interrelated calculation because I'm assuming that all taxes are borne by the resident. And so this will do the interrelated calculation for you. There is a brand new publication from the IRS called Interrelated Estate Tax Calculations. And it is so complicated the way they do it by trial and error. And here you can do it much, much easier. Another thing that I have here is net gifts, where the donee pays the gift tax. And let's say I've made no prior gifts. So here's the taxable gift. And that's if I do it on a net gift basis, it reduces the gift tax, as you can see, because the donee's agreed to pay it. And here's something I don't think any other program has, which is net gifts. The net gift is one where the donee also agrees to pay the gift tax that the donor paid if the donor died within 3 years, that's brought back into the estate, and what that would be. So let's say it's a $20 million, let's make it a $40 million gift, and I'm going to assume that no prior gifts were made, and let's say my donor is, well, I'll start with a smaller, a younger age. And you can see that it didn't reduce it at all, hardly, because from what it would have been without that, because at age 40, the chance of him dying within 3 years is not very much. But if the person were 90, watch what it does to the net gift tax. Oops. Yeah. So it makes a difference how old the person is, as you can see, with a net gift.
And Larry, do you use net gifts or net gifts? What do you prefer to do when a client wants to make?
I haven't done that very often. It's usually some special circumstance that would require that, but it's not very common, I would say. But watch what happens to this Section 35 liability. At age 40, it's only 16,000. If the person is 90, as you can see, it changes it substantially from a few dollars to over $1 million. Because the chance of a 90-year-old dying within 3 years is a lot more than a 40-year-old. Another thing I put in here is some time value of money things. If you want to know present values and future values, if you want to know it for a stream of payments, let's say you want to know what the value of a stream of payments is. make it a 5% interest rate, 10 years. And there's the future value of that. Here's the present value. And let's say I decide that I'm going to actually pay quarterly at the beginning of each payment period, and we're going to compound the interest semi-annually. That would be a really unusual set of circumstances, but if you want to do it, then you can calculate it. And then the final thing I have here is amortization tables, just a simple amortization program, which will solve for most purposes. If you want to do anything more sophisticated than this, you have to get an amortization program. Let's say it's $1 million. I'm going to pay 5% of my rate. And here's the monthly payment I would have to make. And if I want to print out an amortization schedule, here it is with the payments and how much principal, how much interest each year. Or if instead I want to just do an annual summary, I could do that as well, showing how much interest and principal I paid. The other thing this will do is it'll let you solve for any variables. So let's say I can only afford to pay out $9,000 a year. How long would it take me to pay off the loan? And it's going to take longer than 10 years, obviously. It's going to take 12 years. Or let's say I end up paying $10,000 in each payment. What would the interest rate? What's the effective interest rate for that? And it makes the interest rate higher because I'm paying more if that's what my monthly payment is. Or another way you could do it, let's say that I want to, I know that my mortgage rate will be 5%, and let's say I want to get a 30-year mortgage, and I know I can pay $1,000 a month. What's the most I can afford? That $186,000 purchase. And if I could afford to pay $10,000, then it'd be $1,862,000. This will tell you what the current version is always. And this will take you to the Tiger Tables website. But you don't need to see that. You can look at it yourself.
And Larry, you're recommending that people wait and not buy this now, wait until you know the date?
I would wait because we're going to have a new version out as soon as the tables are issued in final form. I would say within a week or so after they're issued in final form, I'll have the program ready to go. I just need to update what the effective dates are so I know which mortality table to have pop up. This, by the way, is that formula for the remainder in a personal residence for the depreciable property in the 2-life situation. That's the one that kind of got me started thinking, what is this thing? So in memory of that formula, I put it on my website as decoration. One of the things I have here, by the way, is the gift annuity rates. You can access the charitable gift annuity rates from this as well.
And Larry, do the charitable gift annuity normal rates, they end up about time value of money, the charity keeps about 50%?
Yeah, that's the idea, that on average, if you have a large enough gift annuity pool, then on average, about half should be left for the charity. And those rates get changed periodically depending on where market interest rates and returns are.
Okay. Larry, would you mind going ahead and taking us through self-canceling installment notes and private annuities? Would you have time?
I have just a few minutes because I have to be somewhere, but I can show you very quickly how that works.
Yeah, good.
Here's a self-canceling installment note, and let's make it 6%, and let's say market interest rate with without the risk premium is 8%. Let's see, 10-year note, 10-year term. Oh yeah, I guess I need to have a lower, let's do it there. Now we'll produce something. There's your risk premium. If you want to have an interest premium, it's this way. If you want to do an interest only note, We'll calculate the risk premium for you. If you want level principal payments, where the principal stays the same, then that's the way that works.
So Larry, so a self-canceling installment note for the viewers is a note where you pay a little bit more interest on the note than you normally would, but when the note holder dies, the note can disappear and not be subject to estate tax. So for somebody who's not in great health, as Jerry Hesh says, if they're drinking a 6-pack a day and smoking a pack of cigarettes, this can be a good bet. But Larry, typically what I think the industry thinks is that the note needs to balloon on the life expectancy of the payee of the note. But Jerry tells me you could have the note go longer than life expectancy, but then you have to manually calculate the risk premium.
Yeah, I don't see that very often. I think that's unusual, and I would say that's untested. I wouldn't do that without a ruling.
Okay.
But the other thing about a self-canceling installment notes, remember that although, as you point out, the value of the note will not be in the estate, but you will have income to the estate for the amount that's forgiven. And under the Frayne case from, that's an 8th Circuit case from some, I don't know, 30 years ago by now. So it's not totally getting off free here, because you do have that income coming back. Then you wanted to see a private annuity, show you how those work. Let's say the interest rate is 5%, 65, value of the property is $10 million, $50,000 basis, or $500,000 basis. And here are the results that shows what the annuity would have to be, so forth. One thing to remember though, if you're using appreciated property, then you have immediate realization of the gain. It's not like the old days where you got to spread out the gain. And let's say I want to do it quarterly, and we're going to defer it 5 years, and we're going to have a graduated annuity of 6%, and it will do that for you as well.
Wow. And then if you die during the annuity term, nothing is left in your estate. The annuity dies when you die.
Right.
So if you apply it with a short life expectancy, it can be a very effective estate tax planning
And so
strategy.
here's how it works.
Very nice.
So that's what it does. The other program that's out there is Number Cruncher, and I am a technical advisor to Number Cruncher, and I view the programs really as complementary. It'll do a whole bunch of things that my program won't do. This program does a whole things it won't do. So a lot of people have both, and a lot of people like the idea of checking them against each other, see if they get the same answer.
That's
So
what
I
we
view
do.
the two programs really as complementary.
What questions do you get most often from your subscribers?
How do I download the new version? I guess the other question I get once a year is someone says, I'm doing a unit trust calculation. I keep changing the interest rate. My answer doesn't change. So I explained to them what I explained to you before about why that's the case. In fact, if you have a term of years unit trust, the formula is 1 minus the payout rate to the power of the number of years of the term. There's no little I in that formula at all. It's 1 minus P to the nth.
Mm.
So I guess most of the questions are really just about how to access the program and how to use certain features, what they mean.
Does it work on an Apple computer?
It does not. And I don't think I get one question a year from somebody who wanted to run it on an Apple. I don't know anything about Apples. I think there's a way they can run Windows programs on Apples. But, law firms and accounting firms almost always have Windows, not Apple.
Right. Law students always have Apples, so they can't use my software either. Yeah.
Yeah.
Okay. Well, if anyone has any questions for Larry, do you want to put your email address up?
Yeah, it's just lkatzenstein@thompsoncoburn.com.
Or you could always Google
Right.
Tiger Tables and probably email Tiger Tables.
Exactly.
And Larry.
Yeah, you could Google Tiger Tables, or here's my email address right here if anyone has questions.
And Larry, what's your next what's your next speech or your next white paper that you're working on?
That's a good question. I haven't quite decided. Do you have any suggestions?
Well, I think how to use tiger tables would be a really good.
Well, see, I wanted to write this so intuitive. People don't need any instructions. And I think if people just play with it, they really don't need any assistance. And I didn't show this, but I do have for every part of the program, I have help screens. And for example, if you go to the Charitable Major Unit Trustman, I have a link where you can download the IRS pro formas, something I wrote about it, some of the rulings that are relevant, some of the other outside resources.
Yeah, I mean, I think that's what's needed, Larry, is just how it's easy to understand your numbers, but how do these techniques actually work, and how, like, can you do a shark fin? You know, can you, those types of issues? Can you avoid the income tax from a self-canceling installment note by making the payments conditional upon living rather than canceling on death? Those types of things.
Yeah. And you mentioned you wanted to see self-canceling installment notes, and I mentioned here some of the risks of those.
Oh, nice.
I said there's no consensus about what mortality table to use, what interest rate should be used, or even the method to calculate the risk premium. So I have warnings where necessary.
That's great.
So that's what it looks like. If people have things they'd like me to add, calculations, I'm always glad to hear about them because I still do my own programming. Which is kind of fun.
Yeah. Do you want to show us your snake?
Sure. Are you seeing me or are you seeing my screen?
I'm seeing both of you.
Oh, let me get the snake out of its cage. Hold on.
Yeah. Brittany, you can close the screen if you like. It was interesting that Larry was telling me when we first started talking that he has snakes, and I took my granddaughter to a zoo and got to hold an alligator earlier this month. That's a 5-foot alligator. He was very tame. His mouth was shut. And then also, the same time, I was able to handle a snake as well. But Larry's daughter is a veterinarian. So I had a very small snake where I was earlier this month. That's a nice Florida corn snake. But look at Larry's. Isn't that a beautiful snake? He is absolutely gorgeous.
Yeah, it shed not long ago, so it's particularly brilliant now.
Yeah. Can we see its head? So that is a king snake, right?
Yep. It's an Arizona mountain king snake.
And snakes are very, very clean. People think that they're slimy. They're very completely dry. They're very clean, and they do seem to like you, right? I mean, they seem to be pretty happy to just kind of hang out with you.
Yeah. Well, I'm warm-blooded and it's cold-blooded, so it likes the heat.
Ah, got it. And Larry said that snake has never tried to bite him. He feeds it once a week is all you need to feed a snake. And they never complain. They don't bark like a dog. They're completely silent. And they seem to not mind living alone. So if you have any questions about mathematics or estate tax planning techniques or the feeding and care of a king snake, you definitely want to talk to Larry Katzenstein. He's your guy for all of those things. How old is that snake?
I think about 5 or 6 years old.
And he'll go 20 years or so?
I should.
Nice. You don't have a calculation of life expectancy for snakes in the software program.
I'll have to add that. The other nice thing about snakes is you don't have to walk them when it's raining.
Yeah, that's right.
Unlike your poodles.
Unlike our poodles, yep, that are very high maintenance.
At least
Well,
you don't
Larry,
get a no-no down there.
yeah, yeah. So Larry, I want to thank you not only for being on this program, but for all that you've done for our profession, because
Oh, thank you.
this area, I think you have been the guy, and it's been a lot of work, and I know a lot, you enjoy it a lot, but we really appreciate how giving you've been with the industry, with your white papers, your talks, and all of that, and your passion for it, which is
Yeah,
really unsurpassed.
it's fun. It's a lot of fun.
Yeah,
Thank you so much.
yeah. Anything else you want to say?
Nope, just enjoy your Halloween weekend.
Yeah, exactly. Maybe some people dress like snakes. All right. Take care, everybody. We'll see you next Saturday at 11 a.m. Eastern Standard Time. Take
Great.
care.